Hey traders, this is Blake Morrow, and with me today I have Jim Welsh from Macro Tides. It is Friday, and it's always nice to wrap up the week with you, Jim, and especially after such an important week that we had this week. How are you doing this week?
I'm doing good.
And I was just wondering if I could say week one more time. Yeah.
Well, it's not been a week.
Yeah, it's pretty weak from my point of view. Anyway, jokes aside, hey, we had a big week though. Nonetheless, the Fed raised rates. I mean, how long has it been since the Fed raised rates, Jim? Do you know?
2018.
I'm sorry?
2018 was
2018.
the last time they started before 2018, but the last rate increase actually happened in 2018.
Okay, so here we are, several years later, we're trying to come off the zero bound and the markets cheered. So why did that happen? Why did we get a rally in equities as we are seeing rate hikes and the market's starting to price in maybe 1.5%, 1.75%, worth of hikes in 2022? Conventional wisdom would tell us as monetary conditions get tighter, stocks should fall, but we got the opposite reaction. So what happened this week, Jim?
Well, I think the overriding issue was China, because on Wednesday night, before the Fed meeting, China reversed some policies that have been in place, aggressively working against real estate technology. There was discussions that Alibaba and a number of other very major Chinese stocks might be delisted from the New York Stock Exchange, or from US markets, I should say. And, China was in kind of almost a free fall for that, as well as a spike in COVID cases. So to me, Blake, China's reversal in policy, in a sense, overshadowed what happened, because it was the surprise element. And the S&Ps overnight were up very strongly. Now, there was a reaction when people looked at the dot plot. Yeah. And so, wow, these guys are tiling in 6 to 7 increases. The S&P sold off 95 points, only to recover again. So I think the main impetus came from China setting a positive tone. And then I think, when everything didn't fall apart completely, you got people buying back. Plus, I'll also mention the market has been pretty oversold. So, you got a big short covering rally is what I think. And it was exacerbated by today is a quadruple witch expiration, options and futures and everything. So as the S&P pressed higher, it triggered, I think, people who were short calls all of a sudden had to do some covering.
Okay, and we're going into the weekend right now. Most people are going to be watching this after the weekend has already happened. So you're talking probably Monday of the following week. China might actually loosen conditions a little bit further over the weekend, right? And that could really help risk assets going into early next week. What do you think?
Yeah, it would. I think, again, and Xi came out last night and kind of said, you know what, we're going to approach COVID cases and outbreaks a little bit differently. In other words, I'm having a complete shutdown, and we're going to go a little bit easier. I think it's just a question of when the PBOC starts to ease more aggressively as well. In October, they have their 5-year, confab of the Communist Party. And Xi's going for an unprecedented third term. He's going to get it. But my point is, it's much better if the economy is improving. And politicians are the same all over the world. They're going to try to put a happy face on the economy. So whether it happens over the weekend, my take was, wow, this was significant this shift. I recommended a couple emerging market ETFs, in part because of that. And that was Malaysia and South Korea yesterday, because I just think that that area has been beaten down pretty significantly. And I do think the shift in China's policy was a major event, and I think they will follow through in coming months.
All right, Jim. Well, it's amazing. I think it's caught a lot of people wrong-footed, positioning-wise. Now we're getting some, kind of some tailwinds behind the market right now. You actually brought us a few charts, and I'd like to show, which one of your charts would you like to show first?
Let's start off with the S&P.
Okay, let's do that. So here we go with the S&P, and what do we got right here?
Okay, what you can see is the S&P in late February 24th, had a low at 41.15, rallied to 44.17, a rally of 302 points. The low last week was, I should say, March 7th, 41.58 at 302 points. You had 44.60. So to me, the potential here is we're going to see the S&P push up towards 44.60. And then you'd have two waves being equal, a big ABC. I'm still not convinced that a bottom is in place, Blake, in part because you're right. Longer term, the Fed is going to raise rates. We are going to see more economic data showing slowing. And normally that is not an easy thing for the market to absorb. In addition, when we start hearing companies talk about first quarter results and then looking into the future, I think there's going to be more downbeat conference calls by companies than upbeat. So as we get past mid-October or April, I think those are the factors that could come in and weigh on stock prices anew.
So your longstanding view has been that we are going to see a new trend low, maybe towards 4,000 before bouncing, but that hasn't come to fruition just yet. But you still are standing by that.
Yes.
Okay. Yeah. All right. Very good. What else we got, Jim?
We got gold.
All right. Let's see gold.
Gold, as we saw, gold had a big spike up, 2,067 on the cash. That compares with 2,070 back in August of 2020. I'm looking at this as being that big move up is a wave 3. This pullback is a wave 4. And as long as we hold that horizontal line, you can see at about 1880. Yeah, I think gold is going to make another push above 2,067 for wave 5. And, again, if it does it, it will then take out the high from August of 2020. So I think that gold is setting up for a move above 2,100. And so I'd be looking to buy this pullback, Blake.
So you're not looking at this as a double top. You're looking at it. It's still going to be a continuation. And yes. if I'm a gold bug, I'm loving you right now.
I can take the love, man.
All right. So what else do we got?
We've got, let's see, TLT.
There you go.
A little bit, I don't know, against the grain a little bit. But what you can see, I believe, is that TLT is nearing an inflection point where we will see TLT rally. And the TLT is basically has an average maturity of about 27 years. So it's closer to the 30-year than obviously the 10-year. Yeah. And I believe that the area around 250 on the 30-year yield, kind of ties in with the TLT around 131. I think, buying TLT on any pullback from here, I believe TLT is going to rally up towards 140 to 142. I think bond yields are going to be coming down in the second quarter. Again, I think we're going to get data that says the economy is softening. The other thing is happening, hasn't gotten much attention, Blake, but there has been a pretty marked increase in COVID cases in Europe. They typically are leading us by 3 to 4 weeks. So I think there's the potential there could be another small COVID scare that could also weigh on economic outlook and be supportive in terms of treasury yields coming down. I believe the Fed, and I've said this going back months. December, January, the Fed was likely to raise rates March, May, and June, a quarter point. And until we see more signaling that they are open to a 50 basis point increase, that's going to be the pattern. They will let us know. Jay Powell left that on the table as I thought he would, because the Fed believes in forward guidance. They want to prepare markets for what's coming. And we'll know before the May meeting or the June meeting if they're going to lean toward a 50 basis point increase, just listening to the speeches and how many people give speeches where they bless the 50 basis point increase.
It's interesting. All right. Well, I think if I'm not mistaken, and having to do with yields and mortgage rates are at levels we haven't seen since 2019 as of today. So It's going to be really interesting to see if yields actually do come down a little bit going into the second half of the year. And your last chart that you brought up is the euro.
Yes.
All right, let's take a look at the euro.
Very briefly, going back, that trend line at the bottom goes back to 2016. There was another low in 2019. So to me, this is a very, very important, significant trend line. The euro touched it, had a nice bounce, is pulling back again. I think being a buyer of the euro, using that trend line as a stop, makes sense. And that line, the horizontal line, is just under 108, because I do believe that the dollar is nearing a high. We're going to see a pullback in the dollar, and that immediately translates into a rally in the euro, one way or the other. The ECB a week ago came out with a more hawkish view than I think most people expected. I think that's somewhat supported. Obviously, the weakness in the European economy due to extremely high energy prices, obviously the Ukraine war, I think all is kind of pretty much in the euro at this point in time. So my expectation is a rally back towards the 114 area. Call it 113.50 to 114 with an outside chance going all the way back up towards 115.
Well, all right, Jim. Well, this doesn't have anything to do with technicals, but let's just talk theoretical here. Let's just say that we have a situation where the Ukrainian invasion by Russia drags on a lot longer than you expect, and then inflationary pressures stay really, really hot in Europe, and then you still have a slower economy. What do you think that the ECB is going to do? Is the ECB going to fight inflation, or are they going to fight a slower economy? Just gut instinct here.
Yeah. No, I think near term, every central bank has to put up the fight inflation front, because rates are still way out of line relative to where they quote unquote should be. And again, this part of raising rates, Blake, is the easy lifting, because they're not going to impair economic growth really that much. The one thing I'll point out is a lot of people say, well, the market has already priced in all this stuff, and the 2 years already up, the 190 or whatever it is this morning. And so there's not going to be any economic impact. No, that's not entirely true, because as the Fed does lift rates that are tied to the prime rate, home equity loan rates and so forth. So there are consumer rates that are tied to the prime rate, which then gets bumped up every time the Fed raises rates. But overall, these first few increases, I don't think are going to have a material impact on slowing the economy. So this is the easy lifting part. And I think all the central banks are going to continue. And we saw it with the Bank of England. They raised rates for the third time yesterday. So I just think that's the conundrum facing equity markets, is we have negative fundamentals for stock prices, and the central banks are going to be raising interest rates. And I agree with you. I don't think the Ukraine war is going to be over anytime soon. The Ukrainians won't accept Russians on their territory, and the ask price from Russia is way too high.
All right, Jim. Well, you heard it here first, folks. Central banks are going to be fighting inflation first and foremost. Jim, I love what you do. I love how you tie in the macro view with your technical views. If I'm a trader, I want to find out more about you. How do I do that?
Send me an email, jimwelshmacro@gmail, and I'll send you last week's, or because this will be viewed. I hope everyone had a wonderful weekend, because they're going to be listening to this on Monday instead of when we're doing this on Friday. But I'll send you next Monday's, the March 21st weekly technical review.
Awesome. Well, Jim, I want to say I always enjoy speaking with you. It's always a welcome thing for me on Friday, because then I know my week is almost over too.
But I'm glad I can be that punctuation mark.
You are right. Exclamation point, really. But I want to say, guys and gals, if you're watching Jim at home and you're watching us on YouTube, give him a thumbs up. If you're watching us on YouTube, subscribe to the channel down below, and so you don't miss any of his content every week. Jim, and it's exclusive here. So Jim, thank you so much for being here, and thanks for joining us today.
My pleasure. Have a great weekend. I hope your weekend was great. Thanks.
You too. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.